The Federal Open Market Committee FOMC meeting is scheduled for 21st, 22nd of March, which is today and tomorrow. During these two crucial days, the FOMC will discuss and decide on economic policies, including potentially raising interest rates to control inflation in the US. The meeting is all the more important for the Fed officials will have to decide whether to ignore the recent failures of the two US banks and concerns about a Swiss bank, either to hold interest rates to give financial systems some time to stabilize or focus on combating inflation by raising rates as planned. Now remember, in the last meeting, the US Feds raised interest rates by 1/4 percentage point, bringing the Fed fund rates in the range of 4.50 to 4.75. Previously, the US Fed gave 4 consecutive 75 basis points rate hike and then a 50 basis point increase in December, followed by a 0.25% hike in January. The Fed will release the summary of economic projections, which will also provide insights into policymakers' view on interest rates and the US economy for the remainder of 2023. So that, of course, is the big meeting that we'll be tracking here. With me, my colleague Karthik and Rakesh continue to be here in the newsroom. I want to come to you, Karthik, first. Some industry experts are looking for a Fed pause, while others are expecting a 50 basis point rate hike. It's going to be a crucial balance for the US Fed.
Honestly, I'm just looking at the reaction, the facial reaction of Jerome Powell. Who would have, who would have thought how this last 1 month is going to unfold? I think in the last FOMC, there would have been no whisker of any inclination whatsoever that we're going to see 4 large banks in the US go down. And Credit Suisse, one of the largest, 30 largest banks in the world, actually be bought by its rival UBS. Now, what should one expect from the US Fed is something which I think is fairly obvious right now. Inflation is high, and it is higher than the threshold that the US Fed has set for itself. Will inflation have to be cooled off? The answer is an obvious yes. Does the Fed have anything in its arsenal apart from raising rates again? Unfortunately, the answer is no. So how much of the rate hike should one expect? I think no point speculating and taking a guess. There are estimates that 25 basis points, 1/4% is what one should expect. Will that really come through tomorrow or not is something that we will have to see. Obviously, there is merit in the Fed trying to extract more liquidity from the market to cool off inflation. That can be done through a rate hike. But of course, we've seen how rate hikes have really impacted the markets and the overall banking sector as well. So one will only have to wait and watch.
Okay. Amit Gupta, who's the CIO of FinTech Capital, is also joining us at this point in time. Amit, thanks very much for taking time out. It's going to be a dilemma for the US Fed, whether to contain the ongoing banking crisis or to contain inflationary pressure.
Yeah, hi, thank you for having me. Yes, usually, 2 days before the Fed meeting, the probabilities of the Fed future rates are trading at 100% or 0%. Which would mean that there is a 100% chance that they are going to move interest rates or a 0 chance that they are not going to move. I think this time the uncertainty is quite a lot. The probabilities are sort of 60-40 of making a move and not making a move, which means that it's really up in the air what the Fed is going to do.
Okay. Karthik, even markets cannot be shielded from Fed's predicament, and it did show up on the markets today.
That's right, Shweta. I think an obvious victim or beneficiary of movement in rates are obviously the markets. I think the markets are also pretty much prepared for a rate hike. So whatever movement in the market had to happen with respect to the rate hike, I think would have happened. And what we will eventually see tomorrow is going to be maybe just a little deviation from the trend that we have seen already. So I don't think the markets are going to be in for a shock or a surprise one way or another. There are expectations of a 25 basis points, rise again. So markets will have to live with that, it seems.
Okay. Rakesh also continues to be with us in the newsroom. Rakesh, what is the stance expectation as far as FOMC is concerned?
I would go with what our expert on the show has said and Karthik has said. I think, without getting into specific figures, because we don't have exactly an idea how do they perform it, but it's clear that there is pressure, so they will have to make a choice, and a hike is quite likely in this case. I'm only on a lighter note happy that the Indian, central bank, the Reserve Bank of India, when it meets, they would be much less stressed than their counterparts in the rest of the world. So that's the good part. I think apart from sitting and just taking a view on the interest rates, I think the entire banking ecosystem in the US and across the West has to do some very, very serious introspection. And that's the good news for India. So far, so good.
Okay.
We don't have to really worry too much about a collateral damage to our banking system, yet stay focused on taming inflation.
Okay, Amit is also here. Amit, given that macro environment is improving, is it too early to call what the hike would be, if any at all?
So we need to understand the background here. The US economy is currently going through a period of economic degrowth and financial instability after these recent bank incidents. So all the historically critical growth areas of the US, whether it is consumer spending or housing or manufacturing, all these are actually showing signs of recession. The only silver lining is that we still have a strong US labor market, though one can argue that this data works with a lag. But we have seen a lot of layoffs in the tech sector in US, also in India. And now this banking sector crisis, I think we are going to see some layoffs there as well in the near future. The second thing is that inflation is quite high, still quite high in US. It's almost 6.5%. So the Fed will be very reluctant to cut rates and go on an easing path. But with so much demand destruction, which has already happened in the last 12 months since they start rising rates, and now we have sort of started getting weak economic data, especially in the housing market, I think inflation can cool off further. But the Fed is basically trying to juggle two balls. One is to save the financial system, and second is to control the inflation in the economy. And I think for this particular Fed meeting, they'll go with saving the financial system gains. So there is a possibility that rate hike needs a pause. So there could be two options. One is you hike by 25 basis points and then you put a stop to the rate hike cycle. Or second could be you straight away go to the pause and hint that we are going to take it as the data comes in. So my sense is they'll do a 25 basis point hike to just to have cover on their credibility. Because remember, before this crisis, the market was actually pricing in 50 basis point rate hike when the Jerome Powell gave a testimony in the Senate. So from coming down from 50 to actually going to pause is a big step. So my sense is they probably 60% chance of them hiking the rates and then putting a stop to the rate hike cycles, and then hoping that the lag effect can bring down inflation in the next 2 to 3 quarters, assuming there are no further surprises.
Okay. I want to bring in India perspective at this point in time, and we're playing the graphic there of RBI versus US Fed hiking interest rates. It seems that there is a clear correlation, Karthik.
There always is, and it's only expected. I don't think there's a big surprise here, because one way or another we are living in a sort of interconnected world, and we can't absolve ourselves completely of the shocks that happen in the rest of the world. So I think it's fairly obvious. Inflation, one part of the world, it trickles down to another part of the world. There's a stock market bull run in one part of the world. More often than not, if fundamentals of the world are sort of equated and equally aligned, more often than not you see a bull run. So bull runs, bear runs, rate hikes, gold prices, all of that is, we live in an interconnected world. So yeah, the fact that that US Fed has been a little ahead of us just sort of helps us also understand what's the mood of the Fed in the US and take action accordingly. But I think India would have had to react one way or another, even if US wanted its inflation to continue soaring, which in the unlikely scenario ever. India had to tame its own inflation as well. So rate hikes in India would have happened irrespective, but yeah, that's not to say that that US would not have wanted to sort of act on its inflation figures. So obviously you see that correlation.
Except that as of now, it looks like India has managed inflation better than US.
That's right.